higher on speculation that surging oil prices may just be a harbinger of a protracted global fuel shortage. Joining us now for more is Thanos Papasavvas, founder and CIO of ABP Invest. Good to see you, Thanos.
Morning.
So you see the possibility, if I'm right, of a mild US recession at only 20%. Just walk us through that, because you've got the likes of JP Morgan and PIMCO saying that the bond market's underestimating the chance of a slowdown. Where would you need to see oil getting to and staying to see that recession?
I think there are some key reasons why we see that probability relatively low at 20%. Although we do see a slowdown, a probability of 30%. So 30% slowdown, 20% recession, 0% hard recession, and 50% continuing recovery expansion. And the reason for that is a number of factors. Number one is that the US economy has been very resilient. It has surprised broader analysts and investors in terms of the resilience, even during the US shutdown last year. That's number one. Number two, we also believe that we're heading or approaching the beginning of the end of this escalation within the Iran war. And the debate internally is whether it's between 4 weeks and 12 weeks. But we certainly see that ending by Q2, end of Q2 of this year, predominantly because of the midterms coming up, the issue of affordability, the price of oil. And for that reason, we do maintain a positive outlook in terms of the fixed income market. We've been positive on the treasuries, and only last week we turned positive in the UK 2 years.
It's interesting because that sort of game theory logic has been the popular idea in markets so far. But as Jemana was just saying, you've got the Houthi rebels entering the conflict now, thousands of US troops on the ground. Are we not at a turning point where markets start to think that this could be a longer, wider war?
Well, we've had 4 Middle East events, crises, over the last few years. The first one, October 23, October 24, June 25 last year, and the latest one. The first 3 were quite sanguine. In fact, during June 25 last year, during the 12-day war, we turned positive. Korean equities, Turkish equities, Central Eastern Europe. This time, we felt it was different because the regime, the Iranian regime, felt threatened directly. The reason why we believe we're approaching gradually towards the end of that is simply because of the pressure points which we think that President Trump will be feeling with the price of oil, if it escalates further from, we saw have 118 WTI crude, or potentially body bags if we go down that route.
So if we would see more fatalities on the US side, you mean Thanos by that? Interesting then, as he says, we speak to lots of people who, just like you, are thinking this won't go on so long because of the midterms, because of that real politics taking place in the US. But before this war even started, we heard voices saying this war won't start because of the midterms, because he won't want to risk higher oil prices into the midterms. I mean, what is the... Are you becoming more convinced of that view or less convinced? How is your thinking progressing?
The thinking has not changed so much recently. It's just a matter of the pressure point of oil. So if the price of oil does not escalate higher, then this can continue. The point is, what impact will the price of oil have on inflation, on the sort of the direct K economy, which we believe is going to be directly impactful and harmful.
Let me ask you about bond markets then, because you mentioned a couple of ways that you've been changing your view, recently upgrading, for example, the UK 2-year. And there has been this talk for a couple of weeks now. Are we underestimating the growth risk? You don't see a recession in the States, but maybe you see more of a slowdown than you did. And is that enough of a reason for markets to start questioning the sell-off we've seen in bonds more globally?
I agree so. I think so too. I believe that. And it's not just in terms of the impact of the economy. It's also that in terms of a broader safe haven. If we see a significant risk-off event, taking the S&P and risk assets down significantly, where is that capital going to go? Whereas post the GFC, we had the zero interest rate environment, we had private equity, private credits, alternatives. Now, some of those asset classes do have a slightly negative feel to them. So we believe that treasuries will be the sort of the balancing, the diversifier in a risk-off environment.
Okay. And just today, we've got stocks selling off in Asia, set to sell off in Europe. They're only a touch higher here, over in the US. What would President Trump need to say to stop the S&P going into a correction? If he were to come out and say this ground offensive is going to be limited and short, would that be encouraging? Because it kind of confirms that there'd be a ground offensive, or would that help the market?
I think that's right in what you're saying. I believe that, in my view, it needs to be a little bit more than just a soundbite in terms of impacting the market, because as you're alluding to, you're saying we are moving to a second stage of this. So it needs to be a little bit more than just a soundbite to an interview, something slightly more constructive. And, for example, saying that of the 15 points, they do agree on some of them. Which are the points? How do we see that communication and that negotiation actually taking place from both sides? I think that would potentially drive the shift.
Thanos, how should we think about the data points that we're going to hear more on this week? We're going to get inflation out of the Eurozone. That should actually reflect some of the impact of Iran, just the very early impact, but it is a number for the month of March. So we'll be looking for Eurozone inflation. We'll also get US jobs data, and I'm not sure what impact that kind of data set will have in a market like this.
Yeah, I don't think the jobs data will necessarily be reflective of the current situation, and both continuation claims, initial claims have always been constructive. The unemployment rate has not really raised any red flags. I think it will be more about inflation. It'll be more about inflation in Europe. We've already heard from ECB's Lagarde saying that we're unlike COVID, which they totally missed. They're not going to allow this to be a policy mistake again, so they'll be on the front foot. Now, the big debate is going to be in terms of Powell Marsh, or Warsh, will Warsh be more hawkish if the inflationary data coming through the US are slightly higher than expected? And that's going to be the big debate over the next couple of months.
Well, yeah, do you think that the reaction function changes with Kevin Warsh at the top?
I do, but I believe that he's an inflation hawk. People believe he's a dove generally. He's a dove because he believes that there are some transformational issues within AI which will bring the broader prices down. And if he's right, then it's worth cutting interest rates. But if inflation is high, I think it's going to be a hawk.
Okay. So President Trump shouldn't assume that he gets lower rates.
That's exactly right.
But and some of that might come down to the AI story that you think is actually, well, that might be part of the reason why the US economy remains resilient.
Correct.
Yeah.
And also while we're also going to be looking at the employment levels within the information sector, which could adversely impact the upper leg of the K economy.
Just finally, quickly, gold. We're nearing bear market territory. Is it a buying opportunity?
We have not turned positive gold yet, and I think there's two reasons for that. We believe that there's just an element of profit-taking, so asset classes which have done very well have really seen a profit-taking to them. One of our clients basically said, yeah, that's a lazy solution, that's a lazy reason. The real reason, which I think is right, is that gold tends to be a slightly longer duration asset, and right now we're focusing on short duration assets.
I was also reading some talking about where maybe central bankers, emerging market central bankers, maybe have to sell gold depending on what's happening to their currencies.
We did that.
Right, okay, so that's certainly worth something we'll watch, and we'll talk more about emerging markets shortly on the programme. Thanos, thank you very much. Thanos Papasavvas, founder and CIO of ABP Invest. Coming up